When I first heard about the Digital Euro project, the first question that came to my mind was, why should I care? So I think for the audience or for this podcast, I think that can be one of the questions on top of mind for them as well. Why do you think businesses and individuals should even care about the entire project?
So as a consumer, trust me, I get this question so much. I get this like, what is this? What good is this? What am I going to do with this? My cash is going to be taken away from me. That's also something I get. I'm from Austria. People are very afraid of losing their cash. So maybe one big takeaway for an individual in the audience is you will not lose access to anything.
And welcome to the Global Policy Podcast. I'm really excited to be here today. A lot has actually happened in the last 12 months. The European Parliament has actually given the mandate for interinstitutional negotiation to commence around the digital euro. I think it's very fundamental to ask the question, can Europe actually build a truly sovereign payment infrastructure? That would actually set the basis of our conversation today. But I think first off, I would really like to kind of understand a little bit about your background. You're currently simultaneously completing a PhD around the digital euro impact on monetary policy, and also at the same time also serving as the executive director of the Digital Euros Association. So I think the question there is, how does all of this connect for you? What drives what you do on a daily basis?
So first of all, thanks for having me as well. I'm looking forward to the conversation. As for, I guess, my personal background here, I think what drives me to do this is also doing so many different things at once is the fact that one feeds into the other. So it's, of course, I have a few different vantage points here. So I have my academic side to things. I have a practical side to things and the neutral platform of being part of a think tank actually on many ends. So I actually get to see what the industry says, what the policymakers say, what I get to write a whole thesis about what I think. So I think it's actually quite cool to do that and to do that in such a fast moving environment, as you said, right? So from the last year or so, even we've seen so much change. Stablecoins are popping up everywhere. Digital euro conversation is also increasing everywhere. It's not just some obscure term people may or may not have heard. Nowadays, people have real opinions about all of this. People realize that they use these things every day, that digital payments are changing, right? I mean, nobody thought a few years ago that you'll be paying with your iPhone, right? Now it's the most common thing, right? We went from cash to cards to this, and that was not just in the span of a generation, but that was basically my career, right? This shift would have changed already, it would have happened already. So I think that's what kind of drives the whole thing as well, right? It's super cool to be part of something that affects us in our daily lives and that changes so much throughout every day.
I think one of the very interesting posts that you actually made of recent, I think, which was where you were actually moderating the closing panel of the Digital Euro Conference. One strategic question that you raised in the panel was the fact that, is Europe actually building or regulating? You asked that question, but I think I want to pose that question back to you. What is your take on this? Do you think Europe is actually building a lot of innovation around some of this critical conversation about digital euro, or you think the core purview is more around regulation?
So I think that generally speaking, regulating is something that we like to do in Europe. So I think everybody knows that. There's nothing even bad about that necessarily. It's just the way that we go here. And I think it's also not even a bad way to go about it, considering there's so many different countries that all need to come together under one umbrella. So to set this sort of the framework first and then to let the market do its thing might actually work just fine, right? And I don't think we've been doing wrong with that. So yes, historically, I think regulating has been priority number one. MiCA is also a big example there, right? We have MiCA on the one hand, we have the first comprehensive stablecoin framework globally, right? MiCA was a precedent there, but it's also sort of emblematic on the other hand, because we have the rule book that's defined comprehensively before we build a mature domestic market, and that's how we go. But at the same time, we're trying to also actively adapt regulation. So the MiCA review is already happening now, right? Input is being sought. The regulation already needs to adapt to the market because the market identified gaps in this. I think this is probably the fastest regulatory review that ever happened in Europe. I mean, granted, it is also the fastest moving sector, probably one of them at least. So I think we're moving from just regulating to building dynamic regulation and to also building actually products and solutions, I will say. So yes, it might have taken a while, and the US obviously took over first, especially in terms of stable coins, and USDT and USDC are the big ones that we're talking about. But we see examples in Europe as well of build side. Well, we have build side evidence. Let's put it that way. We have Quivalis. That is probably the clearest proof that the market is moving from just lobbying to issuing. Actually, we have what started as a 9-bank announcement just a year ago to a 37-bank conglomerate across 15 countries. And that was a status in May. Maybe like there's even more people involved now. So we do see these developments. We even have the Italian consortium with the Eurobank, if I'm pronouncing this correctly, which is also another example here. They have different issuance models and there's a different funding model that they each have, or pooling, so to speak. Nonetheless, like, because we don't know what model will win yet, but we see that there's definitely examples where Europe is building. And even if you want to go back to the ECB, Lagarde herself also would describe the whole USD stablecoin dominance as a concern that would risks entrenching dollarization, and that was a push towards not just a digital euro, but she's using this whole sovereignty language, this march to sovereignty language that says the market needs to develop now. And I think everybody has sort of woken up to this.
I think what is really, propelling this adoption of, issuance of, and, accelerated growth from the euro perspective, I think is also the fact that, 90% of the global stablecoin market is all, dollar dominated. What does that actual statistics actually does to the European monetary sovereignty? How does that impact the European monetary market in itself?
I mean, beyond 90%, right? It's 99+%. Non-USD stablecoin market that has historically been under 0.3% of the global market. So the most recent figure puts euro stablecoins at like $650 million against a total global stablecoin market of 305 billion. I think in January it said at least 0.2%, right? At the same time, though, Europe is, say, give or take, the second biggest crypto sort of jurisdiction. So there's like 20%, again, give or take, of crypto transactions originate from Europe. That seems like a bit of a contrast there, right? So it's not just that the US dominates here, but the share of stablecoins that are US dollar pegged, which is over 99%, exceeds also US dollar's share of traditional finance. So that's roughly like, say, 57% of global FX reserves. Roughly half of SWIFT payment flows are in USD. And even now, the new like digital rails, digital native rails at least, are more dollar concentrated than, well, more than anything before and more than the old system they're supposed to modernize. So that's the opposite of what you'd expect if digitalization were a neutral and like diversifying force. And that's something that in Europe we also feel here. So in the front end, we see when you talk about the sovereignty problem, right, there's two layers to this. So the front end problem is that if the USD stablecoins are embedded into everyday consumer habits, if that becomes a new normal, then European alternatives naturally become negligible or marginalized, not through a single decision or like any one move, but through the whole like accumulated movement that's happening there, right? But at the same time, that's not even the field of tension we're talking about right now. We're not talking about using a stable coin at a point of sale checkout or something, right? That's not where we are yet. We might get there, but that is certainly not like what the situation is right now. That's why also, side note, I don't think that the digital euro is the answer to US dollar stablecoin dominance. And I think largely like the industry agrees with this. I think it's something we do talk about in our little bubble quite a bit. Nonetheless, the actual problem is maybe not the front end right now, but the back end, because settlement and execution infrastructure end up being foreign anchored as well. So we have this like visible instrument that we pay with and like that affects like it touches everyday lives, but also the plumbing underneath. So the rails that are like most users don't even see or think about, that are becoming governed by foreign forces and foreign governments, whatever, foreign private actors, whatever it is, it's nothing that's European bred, let's say. So there are, as you say as well, geopolitical as well as commercial consequences here. On the geopolitical, maybe monetary policy side of things, you have, say, in Europe, somebody who holds the USD stablecoins. They're indirectly exposed to US interest rate policies, right? Not the ECB policies. A USD stablecoin's attractiveness and any pass-through yield that any issuer offers that tracks the Fed and not Frankfurt, right? So Europeans holding the instrument are effectively taking on a foreign central bank's policy, right? So that's kind of where we're again left out in Europe and where the European policy is negligible once again. I mean, de facto negligible, right? In this context, which is a problem, right? If you talk about sovereignty, you also have a political problem here because in a scenario, say again, it's US dominance. Not to be too critical here, but say, and I'm not the first one saying this, US administration might decide that US providers can only serve US consumers, no more, or at least not serve European consumers anymore. It's not the case right now, but technically that could happen, right? And then we're cut off here. So there is also a legal mechanism because the Genius Act actually has like a freeze, seize, and burn mandate, I mean, without getting into too much detail, that would make a decision like this enforceable in practice. It's not just a political statement saying that we're subject to political, like the whims of other politicians. This is actually a possibility, technically at least, right? We're not there, but technically this could be. As you said, commercial consequences we have as well. For a European provider, there's a risk of sort of dying out and not having a market left, basically no leg to stand on to compete against all these US giants. The more and more embedded they become, the more and more this is a risk because they can't build scale and, don't have a track record while all these USD rails are already dominating distribution. So there's no point at which they even can get a fair competitive shot. So this is really another risk besides the geopolitical ones, that we have a purely like a market structure problem here. And to state this also as its own point, as you say, there is a commercial risk here that's not folded into the sovereignty language only. It's just a European market provider issue that they might not be able to compete effectively.
I'm a bit curious because, now that we have a lot of cloud infrastructure provider, they will start asking questions around, the sovereignty as well. What would that, sovereignty conversation actually look like for them?
I mean, I think there's again multiple facets to this. So sovereignty is not just saying we have a digital euro. It's not just saying we have euro stable coins. The infrastructure point is super important as well. So currently, speaking of sovereignty here, right? I think the Draghi report already identified this as well. We import 70% of our technology in Europe, or a bit more. That's insane, right?
That's
That is a
insane.
lot of imported technology. So building your own capabilities there is just as important. So we need European-led infrastructure as well, that in the terms of like digital money as well, relates back to the back end. So we need, yes, infrastructure. We need a wholesale infrastructure as well. Hence the whole digital euro back end infrastructure wholesale development. So it's not a wholesale CBDC anymore, not a wholesale digital euro anymore, but we're calling it wholesale settlement in central bank money. So the Pontes Appia initiative, that sort of feeds into the idea that we want to support the infrastructure being European as well. So this is just as crucial, I will say. I definitely think so.
That's one of the very important questions that has been on top of mind. Now that the ECB have actually moved to the next phase of digital euro, I guess I'm predicting that, issuance would follow maybe from 2029. Maybe you have a different opinion about that. What does that gap between what has been passed today around the conversation that's currently happening and what does the next 3 years look like?
So I mean, first of all, it's not just now that there's suddenly a gap, right? This has been a project that's been ongoing for, at this point, 6 years. So the first digital euro report came out in 2020, and then 2021, it's basically kickstarted the whole project. So now we're at a point where finally we've reached political consensus more or less as well. As you say, Parliament has now at least like agreed on the fact that we're going to start negotiations and trilogues. So it's Parliament, Commission, and Council now starting trilogues and now like discussing actually what this regulation will look like. So that's the legislative end of things. At the same time, technical work is also proceeding. So we have regulation on the one hand, and the market, at least also with the ECB leading it, is building this already. So the gap, if you want to call it that, from now until 2029, first of all, by the end of the year, we're supposed to have a regulation. The trilogues are supposed to conclude by December, like by year end. And then in 2027, we have a regulation. But also in 2027, what's going to start is a digital euro pilot. So we're not just waiting around for 2 years for something to happen, but the ECB is actively testing the beta version of the digital euro. So also to be quite clear, it's not, because the regulation is not final yet, you can't say this is what the digital euro will be like, because there might be some amendments. But give or take, the way that regulation stands as of now, that's what they're going to test in the pilot. So they're going to do that in a controlled environment with ECB staff, with selected providers as well, testing all the capabilities. So there's 4 core use cases they're testing, online and offline in that as well. So they're really trying to see what still needs some figuring out, what works very well. And for instance, like, I mean, if you've seen all the panels also from the Digital Euro Conference,
Yeah.
Alexandra Hachmeister join us as well. And she said that, ironically, I mean, I think that people were like, oh, do you really mean this? When she said, we're hoping to find some flaws.
Yeah.
That we're hoping to find something that doesn't work. And I think that actually is so true, right? Because if it worked so perfectly, I mean, you wouldn't have to wait, right? But also you can't discover everything right away. So you got to give it some time, especially since this is a public sector project. So you got to give it some time, test things, see how people interact with the system, see how long it holds up, like all these technicalities that we might not even think about right now might come to a head during the pilot. So it's really crucial that you actually give this a substantive time period to pan out well. You want to deliver a basically perfect product to the market, right? That's why you can
Yeah.
take your time as well. And as you say, there's a 3 year, 2.5 year, 2 year gap till potential launch 2029. The market needs to fill that. So what we do need, we're coming back to the beginning, Euro stable coins here as well, because they serve different purposes. They serve different use cases. You can't compare a Euro stable coin or any stable coin with a digital euro. So fundamentally, public and private money are not the same, right? When
Yeah.
you
Yeah.
keep it at that basic distinction, these are two different monetary planes we're talking about. And one does not necessarily compete with the other, but one can support the other. Even say, okay, so the digital euro itself is not supposed to be built on blockchain. So the retail digital
Interesting.
euro is not supposed to be built on DLT. A stablecoin works on blockchain, right?
Yeah.
There is a fundamental difference there already. So what the digital euro does is to enable DLT adjacent use cases. So like you can build innovative use cases, say anything with smart contracts, programmable payments, you can build that to interoperate with a digital euro. So
Right.
the market is building these like DLT solutions already, and they can do that with stablecoins, and then they can interoperate with a digital euro as well. So there's not even a competition there, but it's more like a give and take, right? One supports the other, excludes the other.
You mentioned something around programmable payments. How do you see that actually work different from digital euro and stablecoin in itself? What do you think is the major differentiation from, agentic payment or programmable payments perspective?
I mean, I think a major difference in terms of like it's a bit like a direct debit sometimes, I think. So I think the distinction, it's a bit difficult to see the innovation potential if you just think about it very like
Yeah. Yeah.
surface level, right? Because if you say, okay, every month my Netflix gets deducted from my bank account, right? Or your Spotify or whatever it is. Say, let's use a subscription payment actually. So for example, this month my Netflix costs me, what does it cost? 19.99, but actually I kind of want to cancel it, but I kind of only used 1 week. That's a bit unfair, this and that. Thinking this a bit further, rather than deducting it from your bank account for like say August now, and I only watched until the 10th of August and I want to cancel it today, but they're still going to charge me the whole month. What
Yeah.
programmable payments will enable, and what agentic payments in that sense it can also enable here, is that I perhaps only have to pay for the amount of days that I watched or for the amount of movies that I watched. It just sort of reshifts the whole model. So you can actually deliver a more customer tailored payment experience and even like subscription experience and generally consumer experience, user experience here, right? It's not just that money is deducted from my account, but there can be way more nuance to it as well. And that's whether it's a digital euro or any other or commercial bank money. That doesn't really matter because the innovative part here is the payment itself and the fact that you're not just left with the same solutions as you are today. And similarly with agentic payments, the things you can do, it's actually really cool if you think about it. Say I want to buy a coffee machine today, but it's really expensive and I don't want to afford it right now. And I'm sure it's going to go on sale for Christmas or at some point
Or
for
Black
Black
Friday.
Friday. Yeah. Something like that, right? I could actually put in an automated payment order, whatever you want to call it, where I tell my agent, I'm like, hey, I only want to buy this if it goes down to that price, right? I can forget about it. You store your payment credentials there. Obviously, there's a security thing there as well, and they need to be safely stored. But I can just do that and rely on the fact that they will send me a reminder, be like, hey, it's on sale. Hey, we're going to go buy it. And you just click OK. You don't have to sit there waiting for months and checking every day
And
and
keep
seeing whether the
refreshing.
machine is now on sale, right? This is a huge efficiency factor here, right? That we're increasing a lot of efficiency here. So there's a lot of cool things you can do there. It's beyond the direct debit.
Right. I think that's very interesting to see. And I'm very curious to see what the real life use case would look like for both the consumer side as well as institutional businesses, for example, without payments. There's a question that comes to mind when I actually read the DEA's research paper around stablecoins. And there was a particular extract there that says stablecoins are not inherently good or bad for sovereignty. That made me pause a little bit, and I had to reread it again. And it was actually said there that it depends on the strategic policy choice that is being currently implemented. So I think the question now is, what is the strategic policy choice Europe is actually taking at the moment? Or what are the unconscious or conscious strategic decisions that is currently being made regarding this?
So I think, of course, they're not inherently good or bad for sovereignty, because I think if you've read the paper, and for anybody who hasn't read the paper, we categorize by four, we put it into four categories. So we distinguish between foreign issued and foreign denominated, locally issued and locally denominated, and between that also, so locally issued, foreign denominated, foreign issued, locally denominated, so the denomination and the issuance matter. So if you have a US stablecoin issued from the US, obviously greater sovereignty risk than a euro stablecoin denominated in euros issued in Europe, right? So that is fundamentally already something that is why it's not good or bad. So the policy choice will be, how do we support, for example, euro stablecoins? So there are a lot of policy choices going into that, from regulatory design, having MiCA be apt for purpose, and actually, again, what I said in the beginning, also having them respond to the market and the needs there. So the policy choices are enhancing sort of enabling the market to actually deliver on something that the policymakers want, and not just stifling them in their tracks. So I think sometimes what Europe is doing is maybe a bit counterproductive. So with all these instruments that are being designed, I think for fear of disrupting, we go a bit too conservative with things. So even the whole 30 and 60% bank deposit backing of a stable coin is a bit, thwarped in a way, because yes, okay, we have high quality liquid assets and we have safe assets as backing assets for a stablecoin, but we're again tying a stablecoin to the banking system.
Exactly.
We're sort of creating another interdependency there that creates risk and that can lead to spillovers very quickly. So we've seen this with SVB, when also Circle depegged to 87 cents or something. So there are financial stability risks here as well. So it's a bit short-sighted sometimes, I will say, but that's why also market input is really important. I think the same thing applies with the digital euro. I think there sometimes is this conservatism that guides European policymaking that is really should just be done with, if I can be just honest. So I think we see this especially in the contrast to the US, where they are so not conservative with anything. Their whole CBDC ban, separate story, but still, with our digital euro design, we're so afraid of upsetting the banks and of disrupting the system that you're designing something that might actually just be redundant.
Yeah.
Don't get me wrong, I am pro digital euro, but I do think that there are tweaks to it that could make it a better instrument and a more useful instrument. And I think the one thing that needs to change for that in European policymaking is this fear of disruption.
How do you overcome that from institutional perspective? How do we actually overcome that fear of actually disrupting ourselves to actually move things forward?
I think conversation. I really think, and here's my think tank whole background coming in, I think conversation is what helps. I think if you make rules in a room by yourself and you don't look at the world and don't look at the market, it's not going to change, right? But I think that's also something we are seeing, right? So even for us, if the work that I do, say even with the Digital Euro Association, we're talking to policymakers. We have an active dialogue. We have an exchange there to give views and to actually provide more information. This year, we spoke to members of the European Parliament before voting on the digital euro. We gave them our position statement on this. We collected market insights to actually give them a bit more detail on what they're voting on, because also imagine if you're a member of a European Parliament and you're in the Econ committee, you talk about so many different policies that affect the industry, the market, the economic policies in Europe. You can't be an expert in all of them. So at least not to the same extent, and not everybody will be. So it's really important that you do seek that real life input and that you do have the conversation with the market, with the policy voices, that you know what's going on. That's how you relieve yourself of these shackles, I think.
You mentioned a little bit about agentic payments the other time. What we already have in the real-time payment world is fraud. And now that agents will begin to initiate, for example, real real-time cross-border stablecoin type payments, for example, do you think that problem becomes worse?
I mean, let's be real, the more actors and especially like not even real people are involved in the payment chain, the more risk there is. So it's not like me giving you money in cash anymore, where you and I are responsible. We've seen this with APP fraud. We've seen just people, social engineering through social media platforms. There are lots of people, like people, actors, platforms involved in the payment chain now that increase risk. And at the same time, also increase, like, the reasons to expand the liability framework, if you will. So it's increased risk comes with increased responsibility as well on the part of all the actors involved here. So if you have an agent in there and whoever governs that agent, they will also have to take a share in all of this, right? So you can't just say, hey, I'm putting my agent in charge of what I said, storing your credentials. And then somebody hacks the page, and that's my fault that my credentials are stolen, right? So you can't have these things, right? So everything digital payments comes with an increased cybersecurity risk. So whereas my cash could have been stolen out of my pocket, now it can be stolen if I'm hacked. It can be stolen out of my bank account digitally. Different risk profile, nonetheless, there are risks. It's not like it's just safer, it's just a different risk. But also, I mean, if you talk about all of this, you just need to adapt regulation as well. So for us as consumers and speaking for ourselves here, you don't want your credentials to be stolen. You don't want your money to be stolen. I think nobody wants that, right? That is literally the worst thing that can happen to you.
Yeah.
It can affect you immensely. So that's why also all these liability schemes are being expanded to include this. So there is a sense, at least also on the policymakers, regulators part, that we need to involve more people in who is responsible. It's not one side that is to blame. Of course, like if I'm grossly negligible and I transfer money completely randomly and I just ignore all the security alerts, okay, at some point you have to accept responsibility yourself. But there is a lot of fraud that's going on that cannot just be put on the consumer. So we're expanding this to shared liability. In the UK, you have 50-50 liability between sender and recipient, PSP. Then you have Australia, which I think is really cool, now involving social media platforms in all this. So if there's a social engineering fraud and there's a payment fraud that it stems from social engineering from a social media platform, then the social media platforms will be involved here as well. And they have a share in all of this that they need to compensate for. I think that's really cool.
I think it is. I'm actually really curious to see when now agents come into the mix, and would it be that the agent developers or the institutions actually deploy the agent would also have to take share in the risks and liabilities as well? I guess that's the case. Okay, I think we are actually on time, but just a final question now. When I first heard about the Digital Euro project, the first question that came to my mind was, as a potential consumer of this particular type of, asset class, why should I care?
So I think completely different reasons here, first of all. So as an end consumer, I will have a very different interest here than a merchant or any industry participant. So as a consumer, trust me, I get this question so much. I get this like, what is this? What good is this? What am I going to do with this? My cash is going to be taken away from me. That's also something I get. I'm from Austria. People are very afraid of losing their cash. So maybe one big takeaway for an individual in the audience is you will not lose access to anything, right? It's first and foremost another option. It is supposed to give you another digital payment option that is public, that is 100% safe, that is governed by the public sector. It is not something issued by a private individual, by a private company. So we're, again, what I said, we're public-private money planes here. So we have private money, which is all the money we use today in everyday payments, commercial bank money, stablecoins, all private money. But public money, the one that's an ECB liability, a Eurosystem liability, all we have is cash. So now why wouldn't we have a digital cash version there? I don't really like the comparison as digital cash, but for ease's sake, it is just public money made digital. So if I want to, I can pay in digital euros. I know that there is no commercial incentive behind this, them like taking my data away either, for instance, which is a big thing with other providers and international card schemes, sucking off your data, let's say, and just whoever knows where to send that. So there is an incentive if you care about that. If you don't care that everybody has your data, if you don't care that everybody has insights into your payment behavior, which is increasingly going to be the case also with in Europe we have FIDA and in the UK we have open finance now. So like there is an increasing, like, say, transparency drive, but with a commercial incentive behind that, which you don't have with the digital euro. So there is, for example, one way that it might be more interesting to use a digital euro. Just one of them. At the same time, it's supposed to be a one-stop shop solution. So whereas now I can pay with my direct debit and my card and my Apple Pay and all of these things, can make P2P payments, can make a cross-border transfer with different instruments, and they all work. I don't think we have a non-functioning system here. Everything is well served, but you have it all combined under one with a digital euro. So that's something that's also really good. For the market side, you have the same idea, whereas you can develop any solution on this platform. So I think there's one thing for the market that's really important to remember also is the digital euro has a dual function in the sense that, yes, it is an instrument that we pay with.
Yeah.
Tap with a digital euro and it's money that goes, but it is a platform as well. And I think that is probably even the more useful way of thinking about it because it's an innovation platform, as the ECB called it, where the private sector can develop upon. So that means you can develop any solution you want. You can plug into the digital euro network, and then you immediately have pan-European scale. So that is something whereby Europe can overcome the fragmentation problem. So, okay, for instance, the cross-border transfer in Europe, so in the SEPA area, works. Instant payment regulation enhances this. Instant payments for free across all of Europe, but we don't have the same equivalent for SEPA for cards. So if you want to call it that. So that means now if I'm from Austria and I want to pay for my pasta in Rome when I'm on holiday, I cannot just use my Bankomatkarte, but I can only use my Bankomatkarte in Italy if it's co-branded with Visa and MasterCard. Okay? So that puts us in the sovereignty tension again, right? Because we can't pay with a European solution across all of Europe in terms of card payments, point of sale payments, online payments. So we need these foreign actors to come in and to provide the rails for us to do this. Whereas with the digital euro, which is also potentially going to be, can be co-branded with cards, for instance, we can do that across Europe with the digital euro branding, not with Visa MasterCard branding. So it takes, also, it's not supposed to completely drive out Visa MasterCard from the market. It's just supposed to be another option and something that adds to the market, something that allows individual providers to scale across Europe immediately, governed with like sort of a public good sentiment.
This is very, very educative. Learned a lot myself from this, conversation. Thank you so much for the time and, sharing a lot of your knowledge on this podcast. I'm really looking forward to have you back, hopefully very soon as the market actually develops. Thank you, Anne.
Thank you so much.
One of them is like that, a self-directed one where the agent takes on responsibilities or actions that are unacceptable. And a second one, which I didn't talk about, is the adversarial one, which is things like prompt injection. So it turns out, and there was a really interesting recent paper on this, LLMs fundamentally suffer from role confusion. They have a hard time telling the difference between a user-entered command and a command that is from the information they're getting. And what that means is that an adversarial prompt that's in a web page that an agent reads can actually cause an agent to act. And so those two things together really highlight the fact that you need hard boundaries on what an agent is able to do.